put credit spreads. In this tutorial, we're going to go over put credit spreads. What essentially a put credit spread is an option that is usually bullish or neutral strategy. The option strategy has limited profit and losses, and essentially a strategy involves selling a put while simultaneously buying a put further out from the short put. Put credit spread is often referred to as a bull put spread as well. So if you're not familiar with a put credit spread, you might be familiar with a bull put spread. And they're usually a great way to sell option premium with and to avoid potential catastrophic losses that you would try to sell short options or call options. And in this tutorial, we'll go through everything down this list, and later on in the video, we'll do a live trade as well through Robinhood, so you can see what it looks like in Robinhood, and we'll take it from there. So the first thing is your maximum profit for a put credit spread. Your maximum profit is a premium you receive. And how would you figure out what the premium is you receive? So let's take an example. We sell a 48 put for 50 cents. We buy a 47 put for 20 cents. Our max profit is going to be $30. And you ask, how do I get this $30 number? You're going to take the 50 cents minus the 20 cents, which equals 30 cents. Then you're going to times that by 100, which equals $30. That and $30 will be our max profit for this. Our max loss for a put credit spread is going to be the width of the strikes minus the premium we receive. So it would look like the $48 strike minus a $47 strike equals 1 times 100, which is $100. So $100 is what we're going to have to put down as collateral, but minus $30, which we got as credit up here, which is going to equal our max loss would be $70, will equal our max loss. Our risk level usually for a put credit spread are usually pretty low. And this is usually best for getting along on a stock with limited risk. When you want to trade these, this kind of stock or this kind of strategy is when you bet that the stock will rise but don't want to buy a call option. Because call options are fairly risky and you're very unsure of, say you want to buy into a stock and you have a feeling it's going to go up and it's not going down, but you don't want to take that risk and putting your money in a call option where you can pretty much lose all your money. A best thing you could probably do is put it in a put credit spread, and you can lower your risk astronomically. Like I'll show you an example of the strategy that I use pretty much every week. You can make passive income with this every week. You can make between 14 to 20% every 2 days, and essentially have up to 100+% in a month, depending on, if this is the strategy you want to use. And I'll get into that later on in the video as we go through this. And it usually constructs of selling a put and buying a put. And the opposite of a put credit spread will be a put debit spread. And I'll make a video of that later on, and we'll go through it the same way. Alright, so here's kind of the chart of how it would look like. Our max profit up here is $30. So this is our max profit. Our strike prices are here, 47 and 48. In the middle between those two is going to be a break-even point. So we would need the stock by the end of this contract to be above this break-even point to gain any capital from this. If it drops below this break-even point, we start to lose money. Notice here, this is what that $100 collateral is. But you ain't going to lose more than that $100 you put in there. But on top of that, remember, we got $30 back, so our max loss really is $70. Say you lost all the $100. Even though it says you lost $100, you get this $30 credit no matter what. As long as you let that contract expire out, you're going to get this $30. then for our max profit is going to be $30. So as long as we push above this line up here, and if it's anywhere past this line, where max profit will be $30. So what you can do as well, what I usually do, is if I hit a pretty good put credit spread and I'm already hitting my max, and you'll notice when you go in Robinhood, they'll have like plus $20 or plus $30, whatever, depending on what your max profit is. Once you hit that point, and you could hit that point way before your contract expires, you can go ahead and sell that back and get into another position. And I've done that with a couple of stocks. I've hit my max profit, or I get close to my max profit, and go ahead and just sell it or close it out. Not sell it, I'll say close it out, and then get into another position. So from here, this is, as you notice, that this is a put credit spread. And now we'll go into the live example of how it looks like in Robinhood. And remember, the good thing about Robinhood is they'll let you know if you did it correctly. I'll mess up so you can see that Robinhood will tell me, like, hey, it's not a put credit spread. It'll let you know. And we'll go through that up next. All right, guys. Now we're on Robinhood. My favorite ETF, or my favorite stock that I like to trade with put credit spreads, is SPY and QQQ, and I'm gonna tell you why. You can make some pretty decent money doing this, and I'll explain to you why. For one thing, that when you do SPY and QQQ, these things are usually are weekly, and like SPY, I believe it has 2 closing dates, one midweek and one Friday, so you can make potentially a decent amount of money, and I'll show you here what I mean. So notice a closing date of 8, 11, 13, so that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So you got 10 trading days that you can make, passive income with this stock. And when I use this SPY, it's because it's usually pretty slow and usually pretty consistent. And say you make 14% or 10% to 14% every trade, and you times that by 10, that's already over 100% of your return. So you start off with $100, and I'll show you here. So what you want to do is you want to, buy one, then we'll sell one. We'll show you. So you notice here that this is on purpose. Notice here it says put debit spread. If it says your total cost is 20, you did something wrong. Okay. So what you would do is you're gonna the buy or the sell put always goes above your buy. Boom. Notice here, $24 credit. So this is essentially going to tell me, hey, I'm giving you $24 or $26. You saw it constantly goes up. Dollar credit, saying that as long as this stock SPY stays above 372, by the end of this contract, which is in 2 days, I'm gonna receive this full amount credit and get my collateral back. And if it drops below this at the end of the contract when it expires, I essentially will, depending on what it is, I'll lose my capital. And I'll show you here. So here we have, so you're going to get this 25 credit. We're going to get this automatically in your account. And we can do what we want to do. We can just use this as to buy more stock, withdraw it. We do whatever we want with this $25. And here, notice it has $100 a collateral. And what that essentially is just the 372 minus the 371, like I showed you in the other example, which will give us that $100 collateral. And essentially, if you think about it, we're making 23% in 2 days. And we can consistently, remember, do this for 10 days out of this month, and consistently do this over and over and over, and consistently make passive income this way. And this is what I usually do. I usually keep $100 aside, and I keep doing this over and over and over, every week, because SPY and QQQ are pretty easy to read stocks. They're consistently going up, and it's a pretty good stock to do this with. So if you have any questions on this, if you need any help, please leave a comment, like, subscribe to the YouTube for more videos like this, more strategies like this. All my stuff is free. I will never sell you anything, guys. So you get all your stuff for free. Please don't buy anything. Thank you all. You have a great day.